time for Lykken on Lending.
Welcome, everybody. Good to have you with us.
Welcome to Lykken on Lending, a weekly mortgage market update providing up-to-the-minute information on interest rates, loan programs, and hot industry news, all related to the mortgage industry. Brought to you by Transformational Mortgage Solutions. To participate in today's program, our guest call-in line is 646-716-4972. And now here's your host of Lykken on Lending, David Lykken.
Let's begin.
Welcome, everybody. Monday, April 8th, 2019. We say that each week because we do this on, a lot of you listen on a downloaded basis. We have a good number of people listening live. People like we heard last week, Laura Brandeo said that she listens in the car. So wherever you listen, whenever you listen, we're grateful that you're listening to this podcast. Again, if you're wanting to get some updates, take a look at LinkedIn. Real kudos to our program director. He's posting updates on the podcast constantly on LinkedIn, and we're putting little snippets out there so you guys can kind of stay in touch. So if you're not connected with me on LinkedIn, do so. Send the invitation. I'm really at the point now where it's almost approaching 30,000 connections, and that's where LinkedIn cuts you off as being able to communicate out. So we're kind of just letting mortgage people in and some of the real estate people directly connected to the mortgage industry. You'll hear from us if there for any reason I can't accept your LinkedIn invitation. But if you're a mortgage person, you're in. You're in the club. You're in that. And this podcast is created by mortgage professionals. It is for mortgage professionals, and we're grateful to have you as our listener. Again, our commitment is to bring you timely information in an audio format that you can listen to anytime and anywhere. We're also thrilled to be a part of the Industry Syndicate. Go check out industrysyndicate.com and see about all of the other podcasts that are out there. You know, when Alice, Andy, Joe, and I started this now nearly 10 years ago, or it's right at 10 years ago, I'm not sure, getting close, we had no idea how this was going to take off and how it has inspired so many other podcasts. And now it is the thing to get your message out, and there's a whole bunch of them. So who to listen to, which ones are compelling. We're proud to be one of the original podcasters on Industry Syndicate, and so you can listen to us there, and they're really good at selecting who to bring in. They got some great contacts, so check them out. Also, I want to say I am writing now. Fox News, Fox Business asked me to start writing articles. So I'm posting my first article. I sent it in. It should be posted here any day. Maybe it was on Friday. I have to go check the website. And we're writing about millennials. So if you have facts and thoughts about millennials you'd like for me to put out there and give you a comment on, I'd be happy to do so. So anyway, thrilled to have the opportunity to be a commentator both on camera and on the website. So today's podcast in the Hot Topics segment, we've got Tom Hutchens, who is with us. He's Senior Vice President of Production of Angel Oak Mortgage Solutions. We'll be talking about the growth of non-QM loans, and it's pre-recorded. I had to catch up with him. We're also talking to next week's guest, Gabe Minton. We're pre-recording that one. Say, why do you pre-record them? It's because we want these guests and we want to share them with you. And they are busy as heck as well. And so sometimes we have to pre-record more of them than we promised. We love it when it's live, like we had Laura live last week. But some of these have to be pre-recorded. So Tom Hutchinson is pre-recorded. He'll be on today. And then Gabe Minton will be next week. Really interesting content about what Gabe's got. Talk about that at the end of the podcast. Another thing we're doing differently is we are breaking the podcast when we repost it. Now, if you're listening live, you'll listen to the whole thing. It's stretching out because there's so much information to share. We are going over our original hour. Remember when we started this, we go like, can we even cover 20 minutes? How are we going to do that? Remember that, Alice, on site yesterday? It was like, oh my gosh, how can we do this? Joe says, who wants to listen to a guy with a southern accent? Well, a lot of people do. So we've had some great content over the years, and we're thrilled to continue to bring it. But what we're doing is because there's so much content to cover in the first half hour, which kind of goes to 40 minutes, sometimes 45 minutes, we then, if you're listening live, you'll continue right into the Hot Topics segment. But if you're listening downloaded, what we've done is taken the hot topic and we break that out into a separate podcast. It's played the same day or reposted the same day. So if you don't hear it, just stay right there and click on, it'll come right on next. So let's say a special thank you to our sponsors, the Mortgage Bankers Association of America. We'll hear from them in just a minute. Black Knight, the leading provider, and I mean leading provider of integrated software and data analytics solutions. They're doing an awesome job of bringing some critical thinking and great new products to the market. Also, the third largest fintech company in the world, Finastra, is back. We're glad to have them. Finastra's Fusion Mortgage Bot solution automatically addresses compliance issues while delivering enhanced borrower satisfaction, increased productivity, and greater market share. We're going to have a advertising segment for them, so we can stop reading that, but check them out, Finastra.com, Finastra.com. And a special thank you to Open Mortgage, the leading buyer of reverse mortgages, and the home of some of the top LOs. By the way, we're getting more and more inquiries about the reverse mortgage. Got some more messages over the weekend about the reverse mortgage and the Smart Reverse program that they do have out. Get a hold of me or go to openmortgage.com. Reach out to those guys. Also, I want to say Mortgage Collaborative is a big part of what we do. It's one of the co-ops, as well as we have Lenders One. It's a co-op. Both of these co-ops provide mortgage lenders, members, an opportunity to get up close and personal with their other lenders and vendors in the marketplace. One of the things we keep hearing is it's so valuable to listen in a more trusted, intimate setting. What are the struggles of what other lenders are going through? Then Velma, Brent Embler and the team is working on some new products that they're rolling out, but they still have the very efficient mortgage marketing platform that we use. Grateful for that, as well as Knowledge Scoop providing easy and fun training for mortgage lenders. I wish we could just always have Alice Alvey come in and teach us, but he's already got a full-time job at Union Home, so she can't come, but you can go work with Knowledge Scoop. Also, Vidyard is an online video platform for businesses that helps you increase leads and accelerates the pipeline. I'm using this like crazy, and what a difference it makes. So finally, I want to say a special thank you to Alice, Andy, Alan, Joe for their contributions each and every week. Unfortunately, Andy's not here with us today. We miss him and wish him well. So without further ado, let's get over to Rob Van Raphorst and hear what he has for us this week with the MBA Mortgage Minute.
Hi, I'm Rob Van Raphorst. Welcome to the Mortgage Minute and the latest news from the Mortgage Bankers Association. Last week, MBA hosted its annual National Advocacy Conference. Over 400 industry advocates from over 40 states attended. The conference included a slate of congressional and administrative speakers, including HUD Secretary Ben Carson. Also last week, the Senate confirmed Mark Calabria to serve as director of the Federal Housing Finance Agency. MBA President and CEO Bob Brooksmith released a statement congratulating the director and vowing to work with FHFA to resolve the future of Fannie Mae and Freddie Mac. And finally last week, FHFA authorized Fannie Mae and Freddie Mac to release over $376 million to the Housing Trust Fund operated by HUD and the Capital Management Fund operated by the Treasury Department. MBA has long advocated for continuing to fund these affordable housing initiatives as a critical step toward improving borrower access to credit, a reasonable requirement of GSEs with a public charter, and a necessary component of any practical GSE reform effort. That's it for this week. Thanks for joining me.
Yeah, good job, Rob. When you get to the conference and you get a chance to meet Rob, he's usually running. And he's from one thing. They've worked that guy hard, but he does a great job, and we appreciate him providing us. A big thank you to the MBA and our partnership with them. Very grateful for it. Let's run. Oh, wait a minute. Got to say that one little thing just happened again. I found out someone was sharing my business card with somebody, and I got a notification. How cool is that? I'm not going to say a lot because I talked a little bit too much and long in the opening monologue, but check out the digital business card, how you can record your information, put videos up there, and share it with your prospects, those that you want to do business with. And they will be sharing around with others, and then you get a notification. How cool is that? And that's what happened this weekend. I found who was sharing my card with who, and I connected with them, and I was so thrilled. They're thrilled. They're going, this is such a cool thing. Check it out. The digital business card, you can see it on the Lykken and Lending website in the upper right-hand corner. Let's get out to Les Parker with the macro view of the markets with the TM Spotlight and this week's view with another music parody. Les?
Is she Iron Man?
TM Spotlight Soundbite is brought to you by Sloan Logic. Has May lost her mind? Can she see or is she blind? Can she deal at all? Or if she moves, will she fall? Prime Minister May keeps losing votes. The EU said the new April 12th deadline is final unless the UK commits to EU elections. What a mess! The elites in Europe want a United States of Europe without federalism. An oligarchy works for Macron and Merkel, the leaders of France and Germany. Brexit is a symbol of the struggle between elites and populists. The struggle supports the dollar and lower mortgage rates. So, is Prime Minister May a closet elitist? Nobody helps her. Now she has her revenge. These views are my own. Go to tmspotlight.com to subscribe to my daily newsletter.
Wow. Guys, that was really good. Les Parker, good job. Really like it. Also, Gary Kenterbone, great job in mixing that up. Love that ad. And that's really true. What's going to happen in Brexit this week could be big, big, big. And to talk more about that, we've got Joe Farr with this week's mortgage update. Joe, good to have you here, friend. Appreciate you being here for 10 years.
Yeah, how about that? There's a little update to Brexit that had not happened, I think, when Les put that together, and that is that there is a new request out by Theresa May for an extension to June 30th. And that apparently is going to be considered by the European Union governing body at a meeting on Wednesday. So, that's still out there as a possibility to avoid the Friday deadline that currently looms. But, if the EU doesn't approve that extension, we could be looking at a hard no-deal Brexit. So Les is right that it has had some impact on our rates and mortgage rates because of the uncertainty that it will cause if that happens. So we will need to pay attention on Wednesday, and depending on what happens on Wednesday, then we'll need to see what happens on Friday. So it will be an interesting part of this week. So, Dave, just a quick update on today. We've just recently had a little bit of a drop in mortgage MBS prices. So mortgage yields would have gone up just a touch. So up a little, not based on anything significant that I'm aware of. The stock market is down just a little bit, down about 100 points. But, boy, it's been on a nice run, so that's not a big concerning move. Looking at last week, mortgage rates have improved pretty much all month of March. This first week of April, we did see a little backup in that. So rates rose just a little bit in April. Nice thing is stock market rose through last week, and when both improve, like they have been doing, it's been a result of Fed policy, easing of Fed central, not only just the Fed, but central bankers around the world have all conducted monetary policy that's a little easier than what it had been or what it had thought to be. So that's where we are with that. We'll get a little more information regarding our Fed in minutes this Wednesday. They have been market moving last time anyway, and I always say it's hard to imagine much more will be learned from the minutes, but it certainly can teach us more about how the individual Fed members and other, the overall body have felt about monetary policy. So we'll see. So in addition, last week we saw the jobs report come out, and it a much better level of jobs. In fact, the number of jobs created exceeded the expected number by a little bit. But the bigger element of the jobs report that had an impact on the market was the low amount of average hourly earnings growth, only 0.1% in March. That's down from 0.4 in February. And one of the reasons the Fed and other central banks have been accommodative is the lack of inflation as well as slowing global growth. The jobs number, or the average hourly earnings, sure supported a reason for the Fed not to be too concerned about inflation.
Yeah.
In addition, last week, Friday ended some trade talks with China. They ended with progress being made and had a positive impact on stocks globally. There wasn't any progress in Brexit, and as we've talked about, we've got a big meeting on Wednesday, and then on Friday, if they don't extend, will be a big day. In addition, during the week this week, there is an ECB meeting, which will be important as it relates to that central bank continuing its easing of monetary policy, although no major policy changes are expected at this time. Also on Wednesday, CPI comes out, and the minutes of the March 20th Fed meeting comes out. And Jerome Powell's going to be speaking. The Democratic caucus has a 3-day retreat. He's going to be speaking about the economy to that caucus throughout the 3-day retreat, starting on Wednesday. So a lot to look at, Dave, and pretty significant events on the horizon, especially with the Brexit issues coming up.
I'll be real interested to hear if Powell is speaking to the audience, or will he be speaking about the world in a more neutral manner. So we'll see. You know, the Feds have been just too political, and I going, I don't see that.
I don't see that. Anything different to the Democrats than he would to the Republicans. So.
Yeah, I agree. Appreciate it, Joe. Good job.
Okay.
Beautiful day here in Central Texas. Hope you enjoy the rest of your day. And we'll look forward to your feedback on the Hot Topic segment. If you can listen to it, give us feedback. I love that. And also, everybody on this podcast that are listeners here, I'm really looking for feedback on how we can improve this podcast, how we can keep ahead of the curve, make this as compelling and as interesting as possible. So that's what we're working on. So on each one of our segments, give us some feedback. We get usually some good feedbacks. We do get occasionally some things that, hey, I love this. Overall, we get just overwhelming positive feedback. But if there's tweaks that we could make that are more effective, let us know. Appreciate it. Let's run over to Scott Gordon and hear what he has to say and what he's talking about in the science of sales. Scott?
Scott Gordon here with a bit of sales science. Today I want to examine the third and final essential element your story must have, an honest struggle. Your hero must struggle to overcome the relevant challenge that you have laid before them and is essential for good storytelling. Think of real-life supermen that you've encountered. Not the comic characters, but braggarts who you encounter in the real world. Have you ever heard this? Yeah, I started managing the office 2 years ago. Sales were down, originators were slacking on the job, and corporate couldn't decide how to process a loan. But as soon as I took over, I showed them how it was done. Now we close more loans during the holidays than other branches do in summer. First, this guy is annoying. But second, where's the struggle? What obstacles did he really have to overcome? He simply walked through the door and Supermaned his office to success. It's just not a good story because it's missing the struggle, one of the 3 key elements. So with a relatable hero, a relevant challenge, and an honest struggle, you can construct a simple story that leads to a worthy lesson over and over, turning you into a true storyteller. Next time we'll look at how to structure these elements in the most effective way to maximize your stories and your service. This might sound too good to be true, but it's not. It's the science of sales.
I love that. Science of sales. How do we tell our story? For me, I don't know about you. Maybe it's because I struggle with getting it said in the most concise way. How do you get it out? I love telling stories. They are so effective, and identifying the struggle is a great point. Scott, good job. Appreciate it. He is taking his entire top sales crew off to a luxurious place somewhere in the Bahamas, an unnamed, undisclosed location. Well, it's named and it's disclosed. But anyway, they're off there he's sending me pictures from the Caribbean, and it is spectacular where he's at. So I wish he and Tan and the whole team of Open Mortgage all the best on their awards top producers trip. Alice Alvey, you're always good at telling a story, and you've got so much content to share with us. So good to have you with us. For those that don't know, Alice is a CMB Vice President of Education and Training at Union Home Mortgage, and she's here with the legislative update. Alice, good to have you here.
Thanks, Dave. It's good to be here. Well, we have a couple of fun things. I want to tie back a little bit to what Rob was talking about from the Mortgage Bankers Association with the Advocacy Conference. Folks, if you haven't been to that conference, mark it on your calendar right now for next year. This is for anybody in the mortgage industry. It is a terrific event, and one thing that Union Home does, which I just think speaks to the wonderful culture here, is Bill offers this up to any partner at the company, and 10 people from any department actually put their names in a hat. They submit the request why I would like to go. And so we take a crew on top of all the other groups that will go, but even opens it up to really anyone in any area within the company that would like to attend, because it's that important to make sure that we get the representation and they all come away with such great leadership education. So anyway, that's my 2 cents about advocacy. Get it on your calendar for next year. One of the big events, the other MBA event that was this week, I sit on the FHA subcommittee, and we had a meeting this week to talk through the issues related to the new FHA risk assessment. Basically, it's a new algorithm within Total Scorecard that we're all trying to get to the bottom of. Okay, have you seen a lot of refer changes? What have you seen, right? As lenders, one of the things that in this committee in particular is we're all willing to share and can talk through what we're all experiencing so we can get a message back to FHA that this is feeling like a black box right now. The lenders have seen some change in loans that may have gotten an approved eligible with FHA's programming change in Total Scorecard. Others have seen very minimal. We all, as lenders, agree that we need more clarity on exactly what is now going to work. And for those of you who aren't familiar with this, it's a mortgagee letter that came out, and FHA has changed their policy on the combination of a credit score that's below 620 and a DTI that's above 43. When you have those two combined, it's now what are the other compensating factors that make that okay sometimes and not okay other times. So we would like FHA to offer some more clarity on this. And there were some great examples. It's a great example of lenders coming together to collaborate so we can all serve the borrowers better on this. One key thing for those of you out there who have TBD FHAs that are on the bubble, just a heads up, because once you order a case number and put the property address in, you could come up with a different answer from Total Scorecard, whether you're using DU or LP. So just a heads up there. The MBA is working on it to see if we can get some more clarity on the dates. So that was one big thing. Then the last thing I want to make sure we touch base on is MBA also had a great video about transitional and temporary authority for licensing under the SAFE Act. And loan officers, this is in play. So you do have that for the states that have gone around the curve on this already, transitional licensing. The thing that the MBA video needs to add to it would be just those requirements that go with it. So if you have to be employed by a state mortgage company in that state, not convicted of a felony, no cease and desist orders against you in any other state, your license never been denied, and you've been registered with the NMLS for at least 12 months, then you basically get this window when you're moving from a lender to a bank to be able to still originate loans while you're working on your SAFE Act formal 20-hour education and passing the test. So it's a great video. I recommend everybody watch those from MBA and then pull that together with the transitional licensing requirements. So that's my heads up for today, Dave.
Good job.
Back to you.
Lots of good positive feedback on your segment, Allison. Man, it gets downloaded a lot on the website. So good job, great content. Thrilled to have you here. Appreciate it so much. Let's take a quick break. We're going to run over to Knowledge Coop and get some information from them on how you can have effective training.
Hey, Nathan here from the Knowledge Coop. Are you a teacher or coach either professionally or aspirationally? Then let me share these words from Ben Franklin as inspiration. Tell me and I forget, teach me and I may remember, but involve me and I learn. Benjamin Franklin's famous quote has since been proven by science and educators, and they now call it experiential learning, and it's sage advice for anyone in the mortgage industry. So do you have some training to do? Then check out the Knowledge Coop for fun and easy, video-based training for mortgage professionals out there, and it's all powered by a smart digital platform.
Good job. Smart digital platform. Man, these platforms are getting smarter. Check them out, knowledgecoop.com. Great people, great technology, and we're thrilled to have Alan Pollock. Speaking of great technology, Alan, I want to say thank you, man. You dove off an airplane. Alice has had to do this several times. You run to the quietest location you can find and deliver us a report. So I really appreciate the effort, man. Good to have you here with us.
Hey, thank you. I love to be here. And actually, the guy with the broom seems to be following me, and his replacement is now here. So I may be walking around. So I thought I'd start today off, since I have you laughing, with a joke. And this is a good one. It's sort of like part dad joke, part mortgage industry joke. And it's, why was the mortgage loan so lonely? And the answer is because it was a loan.
That is that's bad. That's boo. That is so bad. That is bad.
So I can't take all the credit for that joke. Somebody I spoke to last week shared that with me as I shared another bad one. But this one has stayed with me all week. I'm not good at remembering jokes, so I've told this to just about everybody. So if you've heard it from me already, I'm sorry. It was a good one. All right, so David, this week we got lots of cool stuff going on. We're talking API. We're talking 3 minutes, deposit accounts, and customer experience. Are you ready?
Yep.
All right, so
go
let's
for
get started. Optimal Blue has launched the first in a series of robust APIs. Now, we've heard of them launching APIs earlier in the year. We've heard about some of the acquisitions they've done. This one's pretty cool. And we've also heard, by the way, the word lights out. But lights out integration with investors' in-house systems to automate critical functions throughout the digital loan trading process. And so it allows investors to connect directly to the Resi Trader marketplace. There's the key word, Resi Trader marketplace, and effortlessly automate pricing after pickup, bid tape retrieval, bid placement and return, seller assignment, trade confirmation, and commitment. And I said all those things because all of those things matter. They matter a lot because as you're building, you could be on the investor side building your digital mortgage solution. You could be the lender side trying to innovate the bid tape process. There's all these different areas we work within. So you want to check that out. It's all over the internet. Go take a look. The next thing I want to talk about was Neat Capital. Now, we don't hear from them too often. I'm sure they're out there, but here on our program, they've launched a digital application that gives mortgage borrowers the head start in a competitive market. Okay, that's their quote. It says that they deliver a pre-approval letter straight to the borrower in 3 minutes. Now, why is that interesting? Because they're a fintech company. They're new to what we do every day. And so they do just a soft credit pull. The app is specifically designed for borrowers to be in those different numerous offers in competitive markets. So you want to check that out. Neat Capital. Again, that's all over the internet. And this, David, I thought really caught my eye. This sort of takes us into deposits. It takes us into the last part of the segment. And this is all about Blend. Blend announced that they are now doing deposits. And so and I bring this up for our non-depository lenders because there is this conversation about where the market goes, right? Know your customer. How do you get, for a financial institution, the right technology to sustain and maintain those customers? And when you're a non-financial institution, a non-depository, how do you continue to advertise and get more customers? You know less about your customer because you're not part of their lifelong journey. Well, this was really interesting. So, and I think we've all known that Blend was going to go in this direction, David. So there's 3 points that they made. One is confidently fund deposits in minutes. So reduce the need to go in branch and visit with your mobile first, visit with them. You can go mobile first. The second one was add deposit account offers to your existing loan applications. So if you're a financial institution and you're taking an application, it doesn't have to be just for mortgage. It could be for any type of loan. You now have the ability to offer and let them fund in that same process a deposit account. And you get to work towards an omni-channel experience. So you're using the data, you're leveraging your technology and data to automate decisions based on multiple products through one channel. That is really, really important because as we talk about the banks and credit unions that listen to our podcast, this is where you're gaining that edge on the market. And, I could talk about this all day long, but Boston Consulting Group, which is a very big group, they don't usually publish anything, David, about the mortgage industry, too specifically, especially digital mortgage. Well, they just put out a survey. I'm not going to read the whole survey. You can get it by signing up at Blend's website or at Boston Consulting Group's website. So you can just search. It's on the internet. And they went around to over 20 leading banks and non-banks, as well as service providers and home buyers, and they went and did this survey, right? And we talk about surveys every week, but I thought this was the most interesting. And you said earlier today, David, if you have anything out there about millennials, please let me know. So here it is. They found that they identified 46 digital solutions or features for the digital mortgage process falling into 8 categories. And I'm only going to read the first 2. I'm going to read the first 2 today. I'll go into the rest next week. But let me just read these 2. The first one is Saving for a Home, solutions helping potential buyers prepare financially for home ownership with services such as automated saving plans. How often do we not hear that? So we always forget. We think that the borrowers are us. We think that those borrowers are maybe one generation behind us, but the reality is those borrowers are actually 27-year-olds and 35-year-olds. And so they need to understand how to save with a home. They have the most debt than any generation ever had, but they have the most aspiration. The second thing, David, and this will be the last one for today, is finding a home. Search functions that help buyers find homes, locate real estate agents, and learn more about neighborhoods. So we make this assumption that everybody goes to Zillow and LendingTree and Bankrate because that's what we grew up with. That's what our industry did for so long. But the reality is they want to work with their financial institution. And we heard that from Fannie Mae and others in many, many prior podcasts. So for those of you that are financial institutions and even non-bank lenders that you're trying to get your bank charter, and I know that's a common theme this year, think about the know your customer experience. And know your customer is so broad, but think about who's coming to see you or who is your customer and what do they need from you in the mortgage process. And that omni-channel experience that Glenn just got into, that is so important. It is the experience, the journey, the financial journey of your customer. So with that, David, I won't say the joke again, but, Paul, feel free to post the joke. And omni-channel deposits and 3-minute approvals. Yeah.
Help Alan with this joke. Post them. I heard a funny one, but we don't have time to get into it. But I appreciate you, Alan. You do a good job with these segments. It's a lot of information, and you get a lot of downloads off of your segment. If you want to listen to any of our segments in the Hot Topic segment, other than the Hot Topic segments, you can go to the website, Lykken on Lending, list all of Alice's and then all of Alan's and all of Andy's. Everything they've said is in there and all stacked up in order. And, of course, be sure to friend me on LinkedIn. Add me as a contact. And I guess it's friends for Facebook, contacts for LinkedIn. So connect with me on LinkedIn, and you'll make sure we'll get you the updates. Or if you want, I'll be happy to add you to our mailing list. Let me know. Give me your email address, and we'll make sure we add it. So good job. Appreciate you, Alan. Safe travels for wherever you're at and how you're going. I know you spend a lot of time in airports, but we appreciate you finding a quiet spot. You did a great job. Appreciate it. All right, time for a Hot Topic segment. I'm excited about this one. This one is one of those very, very important ones because there's a lot going on in innovative products. We talk about Calabria now is at FHFA, so we've got some things developing there. What's the future of Fannie Mae and Freddie Mac? Well, we're certainly seeing some non-QM products developing, and that's what this podcast is about. So without further ado, here's the podcast with Tom Hutchens. Here you go. I'm very excited to have with us today Tom Hutchens, Executive Vice President of Production at Angel Oak Mortgage Solutions. And we're going to be talking about a very important topic, one that is getting more and more attention, and that is non-conforming loan products. Tom, thanks for being here.
Happy to be here, David.
A lot of lenders need to be aware of the non-conforming products that are out there. We're going to get to that, but first I want to start with letting our audience get to know you. What's your background? How did you get into the industry? And a little bit of your journey.
Oh, goodness, David. So into the industry, that's been a little over 20 years. So been here a while. Actually just had a really dear friend that I grew up with who talked to me about this crazy business called mortgages and talked me into jumping on board, actually into non-conforming lending back in the late 90s. So been in it for a very long time, experienced the ups and downs of the business, as anybody who's been in the business for a while has, and just excited about what we're doing here over at Angel Oak.
Well, I can't wait to hear about Angel Oak, but did you start in non-conforming type products, or did you make the transition there?
I actually started. My entire career has been in kind of outside the agency box. So, it was called something different in the 90s. It was called subprime. Yep. We don't use that word as much anymore, but yes, I've been really in the non-agency world my entire career.
So let's talk about Angel Oak. I'm hearing your company's name popping up everywhere. Tell us about your role at Angel Oak, and then let's talk a little bit about the company, who's behind it.
Absolutely. Angel Oak started kind of in the midst of the crisis. Just saw an opportunity to buy distressed assets, specifically residential real estate and residential mortgages. Back during the crisis, everybody remembers the phrase of toxic mortgages, and the big challenge back then was for people to know which ones were toxic and which ones weren't. And so some really smart people got together and started buying non-toxic mortgages at toxic prices and really created a hedge fund to invest in these mortgages. But soon thereafter, the vision was very clear that, there were a lot of challenges or a lot of things that went wrong to bring on the financial crisis. But one of them was really the disconnect between the originators and the investors. Pre-crisis, everyone just originated loans and then sold them to the Wall Street firms, and there was no connection. And so Angel Oak was built on the belief that model was probably not going to come back very soon, if ever. So the vision of Angel Oak is we have an asset management side of the business. They manage in excess of $10 billion today. And so Angel Oak Mortgage Solutions, which is where I am, I came on to get this thing going about 5 years ago. And our vision is that we originate the loans in Mortgage Solutions and we sell them into our asset management side. So Angel Oak is part of the loan from the beginning to the end. It is a originate to retain model. And we believe that's a good way to do business.
So let's get into talking about what you're seeing, Tom, with some of the trends that are starting to show up in the market. We've had such a lack of innovation from those days when the subprime came out. I was involved in it early on. The last mortgage company, we did a lot of that work. We started out at Alt-A, and then went into subprime, and then it went into craziness. Fortunately, we sold our business before it got crazy. So we were doing it, I would say, subprime or the Alt-A was done right, if that was. It was still an experiment. But we've learned a lot. So take us through that journey. You've been there all the way through this journey. You've watched all the things where it went wrong. Walk our listeners through that to where we're at today, if you wouldn't mind.
Sure, absolutely. Well, I've already mentioned the kind of the originate to retain mindset. Right. That's kind of a big change. But we also look at, like, for those that have been in the business, the 2000 to 2001, 2002 time frame. That's when loans made sense, and they were all risk-based loans. So, yes, we had stated income loans at the time, but if you had a stated income loan, you had to put, let's say, 10% more down in a down payment. And you probably had a higher interest rate. So it made, the loans made sense. The risk and return were balanced. But then as we got closer to the 05, 06 range, it seems like when Wall Street really dove in, the make sense part and the risk-based pricing really went away. And the guidelines certainly loosened up more than they were ever intended to be. So, an example is interest-only loans. Interest-only loans, as most people know, they're great loans for the right person. But when they became, but when they became just the loan that everyone got, and they got interest only so they could afford more of a house, then that's not really what interest only was created for. That was created for the kind of the financially savvy borrower who knew that they could do better with their money than keeping it at a bank. So we've just seen the evolution of that.
Yeah, I think you raised a really good point. The interest-only loan was designed, and I know whose patent name is on the patent. He's a friend of mine, and he doesn't want to be named anymore because of where it went. And I was giving a testimony, or was actually at the point was doing an interview with CBS Evening News, and I was defending Angelo Mazzello. And I just met this guy, and the next-door neighbor, and he called me as soon as I stepped off from behind the camera. It just lit me up. Man, he was upset. He says, "I created that product. Are you going to be home tomorrow?" And he came back and he built a compelling case how that product was originally designed with a 30% down for people who had a high FICO, had to be self-employed borrowers. I mean, it's just really specific. And they had delinquencies back then at 1/2 of what the Fannie Mae 30-year fixed rate was at. And so it kind of opened my eyes that I think we throw the baby out with the bathwater sometimes. And you're doing some very innovative things at Angel Oak, and I think a significant thing that we need to underscore is that you're originating them and you're holding them in your own portfolio. So they're not being sold off to a Wall Street firm creating another housing crisis down the road. Let's talk about the innovation of products. Where did it get off the rails, and what is a responsible, good, non-conforming, not-agency product today?
Sure, that's a great thing for you and everyone to understand because post-crisis, private capital just left the mortgage market. So the only loans that were able to be originated were agency, the GSEs, and government loans. And then, maybe a small number of bank portfolio loans, but a very small number. So, the GSEs were never created to give everyone in America a mortgage. That's not their purpose. Their purpose is to expand home ownership and things like that. But really what we've done is our mission has really just been to get private capital back into the mortgage space. So, there's been regulations that have been passed, the Dodd-Frank Act, and the biggest thing from that is, every loan that we originate today has to have a documented ability to repay. So, I've already mentioned a stated income loan. Those don't exist anymore. You have to have documentation that a borrower has an ability to repay, not just them stating that they have the ability to repay. And so that's really what we've set out to do is looking at guidelines that make sense to us from a risk standpoint, and then we have to make sure that the loans are compliant, that they meet all the current regulations, ability to repay being one of the biggest, if not the biggest. The good news is now we have a 5-year track record of actual production and performance, and we're on to something, David.
That's what I was just going to go with as you were finishing up your thought is, you have securities, and I want to get into how they are performing so that people can go, and this is directed to 2 segments of our audience. One is the originator. Be aware that this product is out there. And then to the investors that are looking at this market, I want to bring this kind of innovation to the market. You've got a great niche in the market, and you're doing well, but I think it really needs to be underscored. This product is performing. And again, it's not performing for someone you sold it to, it's performing for your own portfolio. So very, very, very important distinction there. Let's talk about the performance. Give us some insights, how well it is doing.
Well, I would start with saying it's performed better than we would have ever anticipated. It's been outstanding. So we've issued, Angel Oak has issued 10 non-QM securitizations, and it's all been Angel Oak production. And I say all, a little bit, maybe not 100%, but the vast majority of those securities have been Angel Oak production, in excess of $3 billion in these securities. So, we're kind of getting that whole securitization model going on. But again, back to the regulation, we have to own 5% of any security that we issue. So it keeps it still under our roof. It's still our skin in the game. The performance of the loans.
Yeah, that's a good point.
Always matters for Angel Oak. So
I said that you're retaining these. You're putting them into securities, but you're the issuer, which means it's your skin that's still in the game. You're still backing, even though you're selling the securities off. And I think that's an important distinction. So you're not taking risks that are inordinate. And I'm thinking about the regulators that listen to our conversation. I think this should be encouraging to anyone who is interested in expanding home ownership. I agree with your statement earlier. We went into a particular time where politicians thought that home ownership is the right of everyone rather than the privilege of those that have handled their finances responsibly. But there are limitations within the agency product. And let's talk now a little bit about where are you finding the opportunities in your niche in the market?
Well, it's non-QM. So the regulations, the Dodd-Frank Act, it defined what they believed as a qualified mortgage, and basically that's Fannie Mae. If a loan is approved through DU, then that's a qualified mortgage. So, one example that a lot of people can relate to is back to this self-employed borrower. Fannie Mae has determined that you have to qualify based on your tax returns. And that's it. You have to show 2 years of tax returns, and the net number is all that can be used. And we would argue that that's the tax code. That really doesn't necessarily show that
represent cash flow.
And someone's ability to repay a mortgage. It shows that you either have a good accountant that understands the tax code or you don't, right? That's why people become self-employed, because the tax code allows you to write certain things off that you cannot unless you are self-employed. So we have a bank statement product, and the bank statement product is something that originators really understand, primarily because every originator who's been in the business since the crisis has had a self-employed deal fall apart. Because the borrower comes in and says, yes, I make X, and then they're processing the loan, they get the tax returns back, and guess what? Their tax returns don't show they make X, so they can't qualify.
Exactly. Yeah.
And so we have this bank statement loan that is really probably the hottest product. And what we do is we look. You just mentioned the word cash flow. We look at a borrower's cash flow. And their cash flow going into their personal account or business account, that's really what determines their ability to repay, not a tax return that is following the laws of the tax code.
Yeah, that's one of the reasons I like the VA programs. It's a residual income approach rather than a tax return approach. You go through cash flow. You really look at someone's ability to repay from a pure cash flow standpoint. How is this playing well within the origination circles out there? How are you finding you're getting most of your business, Tom?
Well, it's playing extremely well as the market has evolved, and since refinances have gone down so dramatically in the last 18 months, our business has done the exact opposite. It's taken off because every originator is looking to grow their purchase business, right? So in order to grow a purchase business, you need to have products. If all you have are Fannie, Freddie, and FHA, you don't have a lot to offer that's a little, unique in the market. So today, any borrower, any potential home buyer, you got to have products to meet their needs. And like I said already, Fannie and Freddie, they're not meant to give everybody a loan. So non-QM is helping fill that gap.
I think it's so important that originators understand that this product exists. So we're going to get right into this, and this is almost crossing over the line of some one of our rules. I want to be informative, but I really want the originators to know about this. So we're going to get right into your title, that's sales and marketing. So what is the net worth of our company that needs to be able to deliver loans? How can they do it? Do you have a wholesale and a correspondent channel?
Absolutely.
Or is it,
and that's what we started this 5 years ago, David, just wholesale, because we knew, warehouse banks and lenders, and they probably weren't going to be the first ones out there offering these loans. So we've done business with some of the biggest lenders across the country through our wholesale channel. They brokered loans out to us where we make the credit decisions and we fund the loans. But in the last 18 months, 24 months, we've seen kind of a transition where correspondent lending is growing pretty rapidly. So, whether you're a lender and you want to be the lender on the loan, or whether you're a broker and want us to be the lender on the loan, either works. We're seeing growth in both channels, significant growth.
That's good. When you're on a correspondent basis, can someone sell you the loan servicing released and servicing retained, or is it only servicing released? I'm assuming the latter.
Yeah, right now it's released because, that goes back to the securitizations. It's important that we are the servicer on these loans. That's part of the whole story is we're involved in the origination, we're involved in the securitization, we're involved in the servicing. Angel Oak is involved in every step of the way.
Let's talk about net worth for someone who needs to get approved with you. What are the thresholds for those that fit as originators of your product and those that don't?
Yeah, broker net worth is pretty minimal. A lot of the states don't even require a net worth to be a broker, so we're really looking at the quality of the broker themselves. When you get into correspondent, then that changes. You've got to have net worth. You have to have warehouse lines. You have to have warehouse lines willing to let you put non-QM loans on those lines. So you are talking two different things. But the good news is that we are here to help with the process as much or as little as possible. You think about a correspondent, the correspondent can underwrite and close loans and just sell them to us on a flow basis, or it can be a non-delegated relationship where we underwrite and we approve and we issue clear to closes, even in correspondence.
And that's where I was going to go. Do you have a delegated and a non-delegated program? I think you just answered that question.
Absolutely.
Oh, that's good. And is it different net worth levels that you have for those designations?
Yeah, and I will tell you though, David, anybody who wants to be delegated, they have plenty of net worth. There's not people with minimal net worth wanting to underwrite and close non-QM loans. It's the market is becoming more liquid, but there's still only a handful of participants in the space, and Angel Oak being the kind of the premier and the largest one.
Well, you raise a good point about the warehouse lenders. They're reticent to get into this, and after many of them carried some non-conforming product in their lines after the companies they were banking went out of business in the last cycle.
Right.
What is the appetite? Is this all the warehouse lenders are signed into this? Is there a select few? Do you provide warehousing? If they don't, how does that work?
So we don't. We are not in the warehouse lending business, but I would say.
So, but
yeah, no. I would say every warehouse lender is really being challenged to participate because, we touched on it, but the performance of these loans, Fitch came out with a study last year where they looked at, it was over $4 billion in non-QM securitizations. I want to say 11,000 plus loans. Okay, so $4 billion, 11,000 loans. There have been 8 foreclosures out of those 11,000 loans.
Wow.
So,
excellent.
Why would anybody not participate? Fannie Mae would love that performance record. So,
exactly.
These are really great loans given to deserving borrowers who just haven't had the options until we came around.
I think when you get into non-conforming, and I've consulted so many warehouse lenders out there, and I know their fear is, well, what happens if something happens to Angel Oak? How many other places could they take that product? For those that are worried about that, we're seeing more and more non-conforming investors showing up in the marketplace. Speak to that.
Well, yes, the market is becoming more and more liquid every day. We were probably the first non-QM security issuer of a securitization around it. But now, if you just read the publications, there's a handful every single month. We're issuing securities every other month now versus once or twice a year. So there is liquidity in the market, and the fact that, like I mentioned earlier about the process, will help a lender originate these loans. It's not just a hands-off. So we'll make sure that these are good credit quality compliant loans that if something were to happen to Angel Oak, which I really don't expect based on all the investor interest and everything else, and again, back to the quality of the loans that we're doing, but there are other buyers out there.
That's encouraging to see there has been some growth. You guys are doing an outstanding job on this. On the underwriting front, do you offer technology that helps them through that or automates like DU and LP?
We really don't, and frankly, it's part of the secret sauce. We manually underwrite, and that's a differentiator to the DU and the LPs because we have credit. We're back to the kind of the good old days. We have underwriters making underwriting decisions, not approving what was told to them on a computer. So
I like that. So I'm a DE underwriter, so I'm really a fan of that.
Well, exactly.
And
exactly
we lost that art, that science. It's a combination of looking at things, and it really was never art, but it's felt like that because why is it that you could get one loan approved or turned down to 3 companies to get approved at a company and have the loan perform? And I think it really goes to the subjectivity and all that goes involved in it. I'm not sure you're going to automate quickly this. Maybe with some artificial intelligence, which we focused on last week on our podcast, but I'm really encouraged with what you're doing here.
We are looking at technology to make the process easier. Automated underwriting, no. We think again that's kind of what makes non-QM what it is. But tools that can analyze bank statements and come up with income and things like that. Those are the kind of things that we are looking to implement to make the process easier for everybody involved.
Well, I'm impressed with the product. How can people get on and start looking at rates and start exploring a relationship with you, Tom?
Our website is spectacular. It's angeloakms.com, as in mortgage solutions. So angeloakms.com. We have all the tools. We have what we call a quick quote tool where an originator can just put in a few pieces of data about a borrower, and we'll tell you right there what type of loan that borrower might qualify for, what kind of rate you would be looking at, and some other high-level information. And they can just click another button and get it to one of our – we have over 100 salespeople across the country. So we have AEs in every market. We're licensed in 46 states. So we're doing business everywhere. So our website website has all the tools and resources. You can get signed up with us on the website. You can learn all about us. We have a blog with lots of training webinars and things like that.
I'm looking at your website. I'm looking at some of the salespeople you have on there. I know some of them. Got a good group of people. Good job at hiring the right, what I think is some outstanding staff. Yeah. When it comes to the future, if we could take a look a little bit, what are you seeing as far as trends? Do you see this area opening up, and are you able to take this product a bit more liberal, or are you saying, yeah, we could, but we're not? Talk about that.
Well, last year, there was $12 billion securitized in the non-QM space. If you look back, again, historically, in 2000, 2001, this non-agency market was about $500 billion. That's right. And then, pre 05, 06, it was over $1 trillion. So we know, forget that number. That number's not even, nobody's even thinking about that. But even if $500 billion is way too much, let's say it's half that. Okay, so it's $250 billion. Well, it was 12 last year.
Wow.
So look at the potential. And to your point, we don't believe that everybody deserves a loan, but we do believe there are a lot of deserving people out there.
Great way to put it.
That don't have the ability to get a loan today. So, let's just say it's a $150 billion a year market. We have 10 times growth based on 2018 securitization. So we just think the opportunity. We believe it's been kind of a niche product, but it's moving its way into a mainstream product, and we think it's here to stay because we're going to continue to originate it the right way.
I'm encouraged that this product is here. I believe it is here to stay, and I believe it's both from a common sense growth from an underwriting standpoint as well as volume. I think this is something every originator needs to know about. Best way for people to get a hold of you or to learn more, again, I'm assuming, is the website. Great looking website, by the way, very informative. And then would they get a hold of one of your account reps?
The best way is we in fact have find an AE, and there's a map on there, and they can click on the state they're in, and we've got pictures of all the people that work with us and their contact information. So really that is the number one way to start is find an account executive, and they can steer you in the right direction and get you going with us as soon as possible.
Congratulations again on the success you've had. Tremendous growth, Tom, and very excited. And let's get you back. I want you to come on back on and talk about the growth in this non-conforming, non-agency type product as the market develops. So would you be willing to do so?
Would love to, David. Yeah, love to talk about the opportunity and the potential of this non-agency business.
I'm excited to have that opportunity. Very excited. Tom, appreciate you being here with us today.
Yep, absolutely. Thanks very much, David.
Great interview. Thanks, Tom, for being with us. Appreciate it. Next week, we have on April 15th, Gabe Minton, EVP and CIO, Chief Information Officer at Guild Mortgage, joining us. We're going to be talking to Gabe about some of the latest developments in technology. Now, from a user perspective, now anyone who knows Gabe Minton knows that he and I used to work together. That's not well known, but I'm very proud of that association I had with him back then. But also, I'm really excited the fact that what he did with things that we'd started with in our committee that we launched, which was that turned into MISBO. So Gabe was the founder, or was the initial founding person at MBA with MISBO, launched that, worked that for years, and then got picked up by a couple organizations and has ended up at Guild. Guild's very fortunate to have a great organization. We're looking forward to him sorting out, the topic is going to be technology, specifically AI. What's the difference between AI, machine learning, RPA, as well as rules-based decisioning? A lot of insights, deeper insights into it. It's a growing topic of greater importance. Then on April 22nd, we've got Michael Fratantoni, the Chief Economist for the MBA, Senior Vice President of Research and Industry Technology, will be joining us. I'm very excited about having him there. So we will be, again, extending this out and just continue to do this. We're so thrilled having you a part of what we've been doing for a better part of 10 years now. And we're excited to continue to do this. We do look for your feedback, and we're getting more and more of it. We want to know what tweaks or changes we can make the need of you, our listeners. So please send me a message via LinkedIn. That's very helpful. or you can text me at 512-632-2900. Thanks for listening. Have a great week, everybody. A special thank you goes out to our sponsors, Black Knight, very innovative company about what they're doing. Looking forward to having them on with some more content. Open Mortgage, Finastra, the MBA, the Lenders One, the Mortgage Collaborative, two outstanding co-ops you should be a member of, as well as Velma, Knowledge Coop, and Vidyard. Thanks, everyone. Have a great week, and look forward to having you back here next week.
You've been listening to Lykken on Lending, a weekly mortgage market update with your host David Lykken of Transformational Mortgage Solutions. Join us next week, and thanks for listening.